The One Up on Wall Street by Peter Lynch is a classic, which provides useful insights for an individual investor who wants to beat the market. Written by one of the most successful mutual fund managers in Fidelity Magellan, the book demystifies the world of investing and arms ordinary people with the capacity to control their financial future. Here is a comprehensive summary that covers all the main themes, strategies, and lessons of the book. Introduction: Why you can beat the experts. Peter Lynch starts off the book by giving a motivational message. Individual investors have a significant advantage over professional fund managers. They are not subject to the same bureaucratic burdens in large portfolios, and they do not have quarterly benchmarks to worry about. He emphasizes that every day an individual is doing something or finding out something that has the potential for becoming a good investment before it has a chance in the professional's world. Key takeaway: investment isn't only a sphere of experts. You can utilize your knowledge and experiences in your affairs to get ahead. Part 1. Preparing to invest. 1. The advantages of being an amateur. Lynch stresses that amateurs often have better chances of spotting trends because they interact directly with products and services in their communities. For example, noticing a packed store or a popular restaurant chain before it becomes a Wall Street darling can provide early investment opportunities. 2. The market is not rational. The stock market, Lynch explains, is driven by human emotions, causing irrational price movements in the short term. However, over the long term, the performance of a stock aligns with the performance of its underlying business. Understanding this principle helps investors stay calm during market volatility. 3. Know what you own. One of Lynch's cardinal rules is to fully understand the companies you invest in. He criticizes investors who buy stocks based on tips or vague information. Instead, he advocates researching and knowing the business model, revenue sources, and potential growth areas. Key takeaway: focus on companies whose products or services you understand deeply. Part 2. Picking winning stocks. 1. Categorizing stocks. Lynch categorizes stocks into 6 types, each with distinct characteristics and investment approaches. 1. Slow growers. Mature companies with steady but slow growth. Examples include utility companies or firms in declining industries. These are suitable for income through dividends. 2. Stalwarts. Large, stable companies with moderate growth. Examples include Coca-Cola or Procter & Gamble. They offer modest returns with low risk. 3. Fast growers. Small to mid-sized companies growing at 20 to 25% annually. These are high-risk but high-reward opportunities. 4. Cyclicals. Companies whose performance is tied to economic cycles, such as airlines or automakers. Timing is crucial when investing in cyclicals. 5. Turnarounds. Struggling companies poised for recovery. They can offer significant returns if the turnaround succeeds. 6. Asset plays. Companies with valuable assets that are underappreciated by the market. For example, a company owning real estate in prime locations. Key takeaway: understanding which category a stock belongs to helps tailor your investment strategy. 2. The 10-bagger concept. Lynch popularized the term 10-bagger to describe stocks that appreciate tenfold in value. Finding such stocks requires identifying companies with significant growth potential, particularly in fast-growing industries or niche markets. 3. The power of growth. Growth is a critical factor in stock selection. Lynch advises focusing on companies with sustainable growth rates, manageable debt, and innovative products. However, he warns against chasing overly hyped growth stocks that lack solid fundamentals. Key takeaway: invest in companies with a strong growth story, but ensure their valuations are reasonable. Part 3. Researching and selecting stocks. 1. The importance of fundamental analysis. Lynch underscores the importance of conducting thorough research before buying a stock. Key areas to examine include earnings. Consistent earnings growth indicates a healthy company. Price to earnings, PE. Ratio. Compare a company's PE ratio to its historical average, industry peers, and growth rate. Debt levels. Companies with manageable debt are less risky during downturns. Dividends. Regular dividend payouts indicate financial stability. 2. Understanding competitive advantage. Companies with a durable competitive advantage, e.g., strong brand, proprietary technology, or cost leadership, are more likely to sustain long-term success. Lynch advises looking for businesses with barriers to entry that protect them from competitors. 3. Red flags to avoid. Lynch warns against investing in over-leveraged companies with excessive debt, firms and industries with unpredictable trends, businesses with overly optimistic projections but weak fundamentals. Key takeaway: base investment decisions on solid research, not speculation. Part 4. Managing your portfolio. 1. Diversification and concentration. Lynch believes in diversification but warns against owning too many stocks, which can dilute returns. He advises holding 10 to 15 well-researched stocks to balance risk and reward effectively. 2. Patience pays off. Investing requires patience. Lynch reminds readers that stock prices can be volatile in the short term, but tend to reflect business performance over the long term. Successful investing involves holding on to winning stocks and resisting the urge to sell prematurely. 3. Monitoring your investments. Once you've bought a stock, the work doesn't stop. Regularly review the company's performance, industry developments, and overall economic conditions. Lynch suggests reevaluating investments annually to ensure they still align with your goals. Key takeaway: stay actively involved with your portfolio, but avoid overtrading. Part 5. Insights on the stock market. 1. The market is predictable in the long term. While the market may experience short-term fluctuations, Lynch argues that its long-term trajectory is upward, driven by economic growth and innovation. This perspective helps investors maintain confidence during bear markets. 2. Ignore market noise. Lynch criticizes the obsession with daily market news and trends, which can distract investors from their long-term goals. Instead, focus on the fundamentals of the companies you own. 3. Market timing is futile. Trying to predict market tops and bottoms is a losing game. Lynch advises staying invested through market cycles and taking advantage of dips to buy quality stocks at a discount. Key takeaway: the stock market rewards patient, disciplined investors. Part 6. Lynch's Golden Rules. Peter Lynch concludes the book with timeless principles for successful investing. 1. Invest in what you know. Use your personal experiences and insights to identify promising opportunities. 2. Do your homework. Research is non-negotiable. Understand a company's business model, growth potential, and risks before investing. 3. Be patient. The best returns often take years to materialize. Stay invested for the long haul. 4. Avoid overconfidence. Even the best investors make mistakes. Accept losses and learn from them. 5. Focus on the long term. Ignore short-term market fluctuations and stay committed to your investment strategy. Conclusion. 1. Up on Wall Street is not just a guide to picking stocks, but also a philosophy for approaching investing with confidence, curiosity, and discipline. Lynch's practical advice encourages readers to look beyond Wall Street and find opportunities in everyday life. By understanding businesses, focusing on fundamentals, and maintaining patience, individual investors can achieve remarkable success. The book's core message resonates. With the right mindset and tools, anyone can outperform the market and build lasting wealth. Thanks for joining me today. If you found this summary helpful and want to dive deeper into more transformative books, don't forget to hit that subscribe button. Join our community of lifelong learners and stay updated on our latest book summaries and insights. And if you enjoyed this video, give it a thumbs up and share your thoughts in the comments below. What principle from this book resonated with you the most? I'd love to hear from you. Until next time, keep reading and keep growing.